Through years of failing in trading, I have tried every single strategy that I could find on YouTube, but when I finally found this concept is when it finally actually clicked for me, and that's when I became profitable. So in this video I will show you the exact strategy that I use every single day to make profits in the markets, and if you stick till the end you will be able to do it yourself. So let's get into it. Before I show you what the concepts actually are, I just want to show you my actual results of the last month, which was February of 2026. So you can see right here that I actually made almost $30,000, and you can see my win rate for the month was 85.71%. And of course you can see here every single win I took and every single loss I took. Also right here you can see how my average days looked. So you can see my profit was around from $4,000 to $6,000 on the days, and you can also see my only loss that I actually took in the whole month. So let's actually right now get into the actual strategy. So the goal of this lecture and this video is going to be for you to actually learn to apply my strategy. So not just to learn it, but to actually know how to counter the charts and how to actually execute a profitable position. And the second thing is to use it and to learn how to use it every single day, because it's actually so dumb, simple, and it's proven because I just show you the results that I actually got for the month of February. And the third step is of course to reach that final level of profitability and consistency where you can actually make profits in the market every single month. So with these goals in mind for this video, let's actually get to what the model actually is. So the model is going to consist, and this strategy is going to consist of few different key steps. So the first step that we need to know that of course exists in the market is structure. So structure is here as a letter S, and of course it stands for a simple structure. So when the market is actually moving to a certain direction, it can be to the upside like this example right here, or it can be to the downside. That is what we call structure, and we will simply identify it by just looking at where the market is actually headed. So once we are on the real chart, I'm actually going to show you how you can spot where the structure is actually moving. The next step is going to be correction. So C is going to stand for correction, and what is that going to actually be? So market is always going to make structure, so it's always going to head either to the upside or to the downside. But the key point is that we need to know that when the structure occurs, we want to see some kind of correction in the market. So market cannot just pump to the upside like this straight forever. So there can maybe sometimes be pumps or dumps, but when the structure occurs, we always want to see a correction afterwards, which will be some kind of move that will go actually against the structure that we just made to the upside, but it will just be to, rebalance the buyers and sellers so market can actually continue pushing to the upside. So structure is going to be really important that we spot it in the market so we can wait for some next steps. So right now what we know is that we will always see some kind of structure in the market, which is just a simple push to one side in the market. After that we can expect some kind of correction, and then after that what we can expect is actually another structure. So this is another structure. So market is always going to move in these simple steps, which is just making structure, making correction, and then making another structure. But this is just what we need to know to come to actually key part of this strategy, which is what is making it so good. So once we know that market needs to make structure and it needs to correct after structure, so the market can actually rebalance buyers and sellers in the market, and it continues to do a structure legs, which is just pushing to one side, the key part of this strategy is going to be called manipulation. So what the manipulation is going to be, it is going to confuse a lot of people, but I'm going to simplify it so it's so easy to understand, and it's going to be so easy for you to actually read market after this video. So after we make structure, correction, and structure in the market, everybody is going to expect the market is just going to flawlessly move to the upside. So what are they going to do? When they see these corrections and they see some kind of retest of their zones to the left, they're going to enter the market. So they're going to execute their position somewhere when we actually start pushing to the upside. So this spot right here is going to be filled with long positions. Of course, they are going to be targeting something to the upside. And where are they going to actually put their stop losses? So their stop losses are going to be placed logically underneath the corrections low. So it's really simple. When we see a structure correction and structure in the market. We know that loads, and I mean 99% of retail traders, are going to execute long positions right here off of some kind of their zone right here that we actually retested. And what they are going to do when they execute a position here, they are going to put their stop loss on this line right here. So this line stands for stop losses. And what the manipulation leg is going to do after a series of structure, correction and structure, it is going to actually manipulate all of them. So market makers, banks, institutions, they can actually move the market because they have power of doing that, because they are trading with trillions and trillions of dollars. What they can actually do is they can drive the market to some kind of high or some kind of low that is going to be filled with stop losses, which equals to them somebody else's money. And they of course want to extract money from these kind of lows and highs into the market, because they want to extract from all the retail traders that are actually going to lose money. So when they drive the market to actually sweep these lows and highs, what is actually going to continue happening in the market? So since they just managed to buy the market right here, because everybody right here was getting triggered and everybody was selling their positions because their actual stop losses got hit, it's going to stop them out of the market and make them sell their position in a loss. And what that means for all the institutions and banks that are trading is they are going to be able to buy a lot into the market right here, because there is going to be a lot of sellers that they just swept out and stopped out. They are going to be able to enter the market with huge amount of buys. And what are they going to do? They are going to drive the price to the upside. Why is that? Because they actually want to sell the thing that I bought here for the lower price, so they have to drive the market to the upside. And that is exactly what we are going to do. We are going to go with the banks, with the institutions, and we are going to wait for the entry towards the upside. But right now, when we know that market is going to move in structure, correction, structure, and a manipulation, we want to see a specific thing that is going to actually make us enter the market, because who knows if the market right now can just start going to the downside. So we actually wait for a specific thing on the chart that is going to tell us, okay, market is actually going to the upside. That thing that we are actually going to wait for is a disrespect of an imbalance. And let me show you how that looks. So we are going to always, for the entry part, look for this imbalance, which is called a fair value gap. And what a fair value gap is, you need 3 candles, as you can see, 1, 2, and 3, and you want to see this hole right here in between the actual wicks. So you can also see we have a imbalance right here, and you can see how this imbalance actually got respected, because the market is actually moving to the upside. If this imbalance is going to get respected like this, we can expect the market continue going to the downside, but then we are not going to execute anything. The only way we can execute into this market is if the market actually disrespects this fair value gap. So if the body, which is this part of the candle, if it actually closes above this fair value gap, which is going to lead us to the next structure part, and this is exactly what that looks like. So you see this part right here, which is the top of the body. We want to see that close above the top of the fair value gap. So if you didn't catch all of the details, we will go over everything slowly once again. But right now it's important, after the manipulation occurs and after we want to see longs happening in the market, we want to see a disrespect of the fair value gap, because that is going to make us sure that market actually wants to go for some kind of highs and wants to actually progress to the upside. So what then happens is we execute an order and we target something to the upside. But right now, let's actually go to all of the key steps in detail. So the first thing we have to do is on the 50-minute time frame, we have to mark out the structure part. So the first thing that we are going to notice is a structure right here, and a correction and a structure. So what the correction will be marked on is the same time frame as we mark out structure. So on the 50-minute time frame, we want to see a pattern like this one. So we want to see a structure getting created, which is just a market moving to one side. We want to see a correction after that, and of course after that we want to see a structure. Now when we see this in the market, we are ready to wait for our position, because we want to wait for the last step, which is a manipulation in the market. So when we have these 3 steps in the market already done, which is just kind of spotting the structure, correction and structure, all we do is we wait for the market to come down and to actually clear the low of the correction, because that is where the most amount of stop losses is going to be, at that specific low. And then when the actual manipulation occurs, which is just moving to the downside and sweeping the low of the correction, all we do after that is we just wait for the entry, and that is it. So the entry is going to be after the sweep of the correction's low, and then what we do is we wait for the disrespect of this fair value gap right here, which I'm going to show you the exact time frames and how is it best to catch, of course, the biggest moves and the most probability moves in the actual market. So I'm going to show you all the time frames later, but right now when we actually get this disrespect right here is when we actually enter the market. So we enter the market, put our stop loss below, and we target some kind of highs or to the upside, and that is it. So this is our whole model. Like this, it looks like absolute nightmare because it looks so complicated, but when you put it together slowly, like structure, correction, structure, we get a manipulation, and then we continue with our structure, of course, later on, correction, structure, manipulation. So it's always going to be the same thing that is going to actually circle in the market. Right now, on to some key rules that you have to follow in order to actually make profits in the market. The first one is going to be to trade within market open hours. So me personally, and I personally trade the New York session, which starts from 9:30 and ends at 11 a.m. So you want to specifically target market open hours. It doesn't have to be New York like mine, but it can be Asia, London, or New York. So just look up what a session hours are and make sure that you are looking for these setups within the market hours. So this is Eastern time right here, so 9:30 to 11 a.m. is the New York session. The second thing that you need to know is that it works on everything. So crypto, indices, forex, it works on absolutely everything, but the point is that you only want to trade one instrument. And why is that? Because if you trade 3 different instruments, it is going to really confuse you. So if you just focus on one instrument, pick it out and then focus on it, and make sure to just look for these setups on that one instrument. So don't worry about how much setups you're gonna get. You're going to for sure get enough setups, but if you are going to trade 5 different indices or 5 different, I don't know, forex pairs, it is going to confuse you so much, and you are not going to be able to focus and to actually execute correctly this strategy. And the last thing before we actually get to actual chart example is I'm actually going to give you my free 10-page playbook about this whole model. So it's gonna be linked down there after this video. Also, if you like the value that I give in this video, make sure to smash that subscribe down there, which is just going to let you know when I upload my newest video. So it's just going to pop up first on your home page. And also like and maybe comment some kind of questions if you have. I will for sure answer all of them down there. So let's right now get to the chart example. Alright, so here we are at the actual live example. So I'm pretty sure by the picture right now you can already kind of spot something that is happening in the market, and I'm gonna mark it out perfectly. So the first thing is that we notice right here, of course, is going to be that we are actually making structure to the upside. So for the sake of the video, I'm gonna mark it out with the same color as I did just before. So it's going to be a purple color like this one. So this is structure. So you can see that market actually made a move to the upside, which is just letting us know that this is a structure leg right here, and it expands all the way up to here. So all we want to see next is, of course, a correction leg. So if I take another box and if I color it blue like we did before, and we take a nice little look at what the correction is right here, so everything that is going to the upside and the biggest low is actually end of the correction. So from here to actual biggest low that we made is a correction. After that, all we want to see is where another structure is, and another structure is lying right here. So you can see from this point right here to this point right here, this is the new structure, because after we made a structure to the upside, then a correction to the downside, after that we finally made our another structure. So we started moving again to the upside. All we want to see right now is, of course, what is a sweep of the low of the correction. So for this to get swept, that is going to make us know that we actually got that manipulation leg, and after that what we can do is we can start looking for some short positions. So we just right now wait for the actual sweep of this slowdown here. So let's actually see if we are going to get it right here, and when we get it, that's it. Right now we stop, and right now what we do is we start looking for the setup. So we can also mark this out with the red color. So this is our manipulation leg. So if you want, this is the whole model. So you have structure, correction, structure, and then a manipulation. So right now what we do is we strategically scale to the lower time frame. I wrote right here exactly what we are going to do. So these right here are the time frames. So the first thing, from the 50-minute time frame, as you can see right here that we are on right now, we are going to scale down to the 5-minute time frame to check if there is fair value gaps. If there is no fair value gaps for entry on the 5-minute, we scale to the 3-minute. If there is no fair value gaps on the 3-minute, we scale to the 2-minute, and we go from 5 to 1 till we actually see a fair value gap. So if there is a fair value gap for a entry on the 5-minute chart, we stop right there and we do not scale down anymore. If there is one on the 3-minute, we stop right there, we wait for the entry. So whatever time frame you see an entry on is the time frame that you stop, and you wait for that entry to actually happen in the market. So the highest time frame of these that have a fair value gap to a entry is the one that we will execute from. So let's actually scale to the 5-minute time frame like this. And right now let's see if we do have any fair value gaps. So if I fast forward the market one more bit, so let's actually see if we have any fair value gaps. So right now you can see we do not have any fair value gaps. So right here there is no fair value gaps that were created while we were actually going for this low right here. So what we do is we scale down to 3-minute time frame. So let's see on the 3-minute time frame, and on the 3-minute time frame there is a different story, because we do see a fair value gap right here. So all we do is we mark it out like this, and you can see this is our fair value gap that we will wait for to actually make an entry to the market. So really important thing is we do not scale down even more, because we have our fair value gap on the highest time frame actually right here. So from the 5-minute we didn't have any fair value gaps. On the 3-minute we actually do have this nice fair value gap. So all we do right now is we wait for the inversion of this fair value gap or an imbalance. So this right here, you can actually see we still didn't close above this fair value gap, so we still wait and let's see what happens. And there it is. So this is our closure right here. So we mark it execute right here. What we do is we put our stop loss. So right now this is really important. We can put our stop loss right below the fair value gap, but the point is stop loss is going to be way too tight. So what I like to do is I like to give it some kind of space, and I want to do it logically. So sometimes I like to put it under the body, but since we do have another fair value gap that we actually created while going to the upside, it would be really good to put it under this fair value gap, or you can put it under the body. So nothing is mistake, but as long as you don't do it way too tight, you are going to have no problems at all. So all we do right now is we scale to the upside and we target the biggest high that we actually made, and you can see that is 2.18 risk to reward. That could have also been 3.7 risk to reward if we put our stop loss on this fair value gap, but this is completely fine for us, and let's see what will actually happen in the market. So you can see right there, in about 10 minutes we just went beautifully to our TP, and I just want to put this for reference. 2.18 risk to reward. If you have a simple $100,000 funded account, which is very easily achievable, and you can have loads more of those funded accounts, this would be on a 1% risk $2,180. And of course, if you put your stop loss even tighter, like on this fair value gap right here that we marked out recently, this would be $3,600. So just imagine how big can you scale with this strategy. And that is it. I don't want to make this video any longer, because this is a really simple strategy that you can actually execute every single day, because it's so simple. But before I actually finish the video, if you liked it, of course, like the video, make sure to ask any questions you want in the comment section, and also subscribe to the channel so you never miss another video like this one. One more thing that I want to add is, if you maybe want to get to work with me personally one-on-one, there is a link down there that you can actually apply for the mentorship. So spots are limited, so if you want to do it, make sure to do it fast, because I only accept people that are going to put the work in and that are going to actually make results. So yeah, basically with all of that being said, I hope that you like this video, and I'm just gonna see you in the next one. Peace.